Welcome to On My Way to Wealth, the podcast where busy Gen Xers can learn financial tips as they navigate life on their way to wealth. And now, please join your host, Luis Rosa.
Hello, everyone. Welcome to another episode of On My Way to Wealth. My name is Luis Rosa, and I'm your host. I hope you and your family are healthy and safe. I want to talk about demystifying your credit today. Do you really understand how credit score works? How is your FICO score derived? What is the formula? Is it just one big, I don't know, I just pay my bills and hope for the best? Not really. I'm going to tell you today the exact way that your FICO score is calculated so that you can make some moves if need be to better your chances at increasing your score and then be able to qualify for those things that you might be looking into, whether it's a car loan or a better rate on a credit card, personal loans, or refinance of your student loans, refinancing your mortgage, things of that sort. All those things require credit. So we have to learn how to work the system. So let's talk about it. FICO. Do you know what that stands for? FICO. It's a Fair Isaac and Company. Just a little trivia there in case for some of you that may not have known. So let me tell you a little bit how the credit score is calculated. Let me tell you the groups. There are 5 categories that go into this. The first thing is payment history. The second things are the amounts owed. Third thing, length of your credit history. Fourth is new credit. And fifth is credit mix. So I'm going to tell you what each of those categories mean in terms of a percentage of your FICO score. And hopefully that helps you to understand better and perhaps make some changes if need be. So let's talk about the importance of these 5 categories. Number 1, payment history. This makes up 35% of your overall credit score. The first thing any lender is going to look at is what is your credit history. I've spoken to some people that have told me that they don't use credit because they'd rather not get into trouble. And I understand that it's a valid point, but I tell them, look, it's really one of those things that it's a necessary evil, if you want to call it that, because the first thing that a new lender is going to look at when you apply for credit, because a lot of us don't have that much money to buy a house cash or a car cash, you need some form of history to show this new lender how well have you paid your other lenders, because that's going to really tell me as a lender if you are a good risk or not. And this is what this whole scoring system is all about. It's a prospective lender looking at you and saying, how much of a risk am I taking by lending you money? So category number 1 is payment history. It makes up 35%, which is really the largest chunk, as you'll see in a bit as I get into the other categories. So this is the first thing somebody's going to look at. So put yourself in the place of a mortgage lender, a car lender, creditor, as far as a credit card or personal loan, and you go to them, right? Somebody comes to you and wants to apply for credit. Well, the first thing you're going to want to know is that, can this person pay me back, right? So one of the ways you're going to find that out, aside from checking their income, is, well, how have you paid your other creditors in the past? Because that might be a good indicator to me as far as how you're going to pay me, right? So 35% of your credit score is your payment history. So this is very, very important that you stay on top of those payments. So sometimes, I know for some folks hearing, times might be tough every once in a while, but just make sure that no matter what, you stay on top of your credit. Even if one day you have to make a minimum payment, it's better than missing the payment altogether as far as your credit is concerned. The second item is amounts owed. So having your credit accounts spread out might look better. Let me give you an example. Let's say that you have 2 credit cards and they each have a $10,000 credit limit and you owe $5,000 to each. Now, you owe $10,000, but you only owe $5,000 on each card. Now, let's say I owe the same exact $10,000 that you do on one card that has a $10,000 balance, and I owe the whole thing. Although you and I owe the same exact amount of money, everything else being equal, your credit is going to be better because you only owe 50% of your overall available credit, and I owe 100%. So I am maxed out. So when I go apply to a new lender, and they look at, well, this guy has a $10,000 credit limit and he owes $9,999.98. Well, he's tapped out. So that might not be a good risk for me to lend to somebody who is already maxed out on their credit. So this is another opportunity here. If you have multiple credit cards, you might be able to switch around some of the balances, maybe via balance transfers and things like that. But be careful too, because sometimes when you're offered a 0% APR balance transfer, for example, you want to jump on that opportunity and max out that new APR card that gave you that 0% for 18 months or 24 months. The problem with that is that you end up taking a brand new card that you just opened with 0% APR and maxing it out. And we're going to get into a little bit that later as well. But all of a sudden, you created a problem for your credit because, yes, it's good for you from a cash flow standpoint and saving money on interest, but you've now created a different set of problems where you opened up new credit and you maxed it out because you're doing this APR balance transfer, right? So when they run the credit next month, you have a brand new card that is tapped out. So sometimes it's good if you could to ask for more than you need. You know, let's say you wanted to do a $10,000 balance transfer, maybe you can get 20,000 on that credit limit if possible, and only transfer 10 so that you're still at a 50% ratio, right? So think of those things when you're doing these moves, because sometimes they can save you money on interest, but then they can cost you in the short term as far as your credit score. Also, the length of your credit history. This is very important. The history that you've built over time, that also has a nice impact. So amounts owed was 30%, payment history was 35%. The length of your credit history is 15% of your overall score. So having accounts for a very long time is really, really helpful. So this is, again, bringing back up the balance transfer scenario. A lot of us make the mistake of closing the old accounts that we just finished paying off because we feel like, hey, you know what? I just got this new 0% APR and this new card. I'm just going to transfer all these balances and I'm going to close these cards out. Or if you pay them off on your own, a lot of people say, hey, I just want to be free of these cards and I'm just going to pay them off. But guess what? You know, if you're like me, like I got credit cards since I was in college. You know, they were in the books at the bookstore. I didn't even have a job. You know, one of my first money mistakes right there. I got credit cards when I didn't even have a job because they were right there in the books at the library when I went to college and applied for, you know, just to get my books. And I was like, all right, I'm applying for it, right? So that's another episode for another podcast show, right? But basically, I have credit for over 20 years now, way over 20 years. So I went to college when I was 17, almost 18. You know, I turned 18 freshman year. So I still have those cards, and they are a huge impact on my credit score because I've had that history. So make sure that when you do establish credit, that certain cards you use, you need them for that stability of credit history. So even if you pay them off, don't necessarily close them, you know, because you need a history. So think about perhaps just having something that you use often, like a Netflix subscription or something like that, have it on that card and pay it off every month. So it doesn't mean that you need to carry a balance in order to continue to use it, right? So think twice before you just say, you know what, I'm just going to cut this card and call them up and close it, right? So credit history, 15%. Now, what about the credit mix? Credit mix is 10% of your overall. Now, this means that it's always good to have a fair amount of different types of credit on your overall credit report. So I'm talking about student loans, installment loans, a mortgage, retail accounts, credit cards. You want to have a mix, right? So you don't only want to have, hey, I went to school and I have student loans, so I'm building my credit. Yes, you're right. But it is better when you have a mix of credit because also creditors want to see how you handle different types. You know, can you handle an installment loan that has a fixed payment, like a car loan, for a certain amount of time? Can you handle a retail account that's given to you at a store, right? Like just a regular a clothing store, for example. Can you handle a one of the major cards, right? And also, can you handle a mortgage, right? So you want to have a nice mix. So Most of us probably have student loans right off the bat from college. I would recommend that you open up a major credit card if you can. If for some reason you're establishing credit for the first time and you don't have the ability to get a major credit card, open up a secured card. You can go to a bank, you basically make a deposit, and they lend you back your own money. It's secured by your own money that you made in that deposit. So there's very little risk for the bank in that scenario. The good thing for you is that that then gets reported to the credit bureaus and you start building that credit history. And maybe after a year or so of having that secured card, you can apply for an unsecured card that does not have that backing, but you having to make the deposit. And that looks even better on your credit report. So you have that nice mix. You'll have student loans, secured card, unsecured card, and just make sure you mix it up a little bit so that eventually you build up to the bigger things like getting your car loans or that mortgage, right? And finally, new credit. New credit makes 10% of your overall FICO score. So a lot of the times when people have all these inquiries on their credit report, that doesn't look good. Over time, you want to be careful. Like if you are shopping around for something, you don't want to have what's called a hard inquiry on your credit report. I think a lot of you have seen those terms, hard inquiry versus soft inquiry. A hard inquiry is when you actually applied to get credit. So you don't want to have 20 inquiries on your credit report because then that looks just like you're desperate for credit, right? So if it's definitely reasonable to shop around, especially when you're trying to get a car loan or a mortgage, right? Maybe look at 2 to 3 places max, and then make your decision because you want to be careful of having those hard inquiries. Now, a lot of places do offer a soft inquiry before they make a decision, which is fine. A soft inquiry does not count against you as an inquiry on your credit report. Typically, if you check your own credit score, let's say you go to annualcreditreport.com, that is a free service. You can go there once a year and get your credit report from all 3 credit bureaus. Now, what I usually tell people is you don't have to pull all 3 necessarily. You could pull, like, say, Experian, and then maybe 4 months later, pull Equifax, 4 months later, pull TransUnion, just to stay on top of your credit report with the different agencies, because not every creditor reports to every single credit agency. So you want to make sure that you know exactly what's on all 3. Now, at annualcreditreport.com, you don't get your actual score, but you have the ability to purchase it. But start off at least knowing what's in your credit to begin with, and then you can take it from there. Also, as far as new credit, you might notice sometimes, like even if you have a good credit history and a good score, sometimes when you initially get brand new credit, you might see a decline of a few points in your credit report. That happens sometimes. You might get, say, a car loan, and now you notice that your credit score just went down just because you have that new credit. But don't panic about that. Usually it's not a significant drop, but it will come back as you build that credit history with that new account. So somebody the other day asked me about one of these Boost credit, I think Experian Boost. They basically have the model FICO 8. And there's different models of FICO score. So the FICO 8, you can use Experian Boost to increase your credit score by using things that are not always reported on credit reports traditionally. For example, utilities and cell phone bills, phone bills, things of that sort. Now, obviously, there's no downside to that. If you want to go that route, go ahead and do that because you could boost your score. But just keep in mind that not every lender that you go to will use that particular FICO 8 model. So just because you use, say, Experian Boost, for example, and you got your score boosted, it does not mean that then you can go and apply for a mortgage and your credit score is going to be higher, right? So something to keep in mind. It is unfortunate that most creditors really don't report things that we pay on time all the time, like rent, for example. That doesn't get reported to credit, your utilities, your cell phone. However, if you default on any of these, it is very likely that that creditor could report that as a negative. So it's kind of messed up because you don't get the benefit of paying on time. And if you don't pay on time, you might get the downside of having been reported to your credit report. So, which is why payment history makes up 35% of your overall score. So make sure you keep those in mind. So just as a quick recap, payment history, 35% of your score. The amounts you owe, 30%, the length of credit history, 15%, credit mix, 10%, new credit, 10%. And that is how your overall FICO score is calculated. If you have any questions, send me an email at luis@onmywaytowealth.com. And also, if you have any topics for a suggestion for a future show, definitely send me an email. As a reminder, the show is now weekly, every Wednesday morning. Thank you all for listening, and I'll see you in the next episode. Thank you for listening to On My Way to Wealth. If you have any questions, please send me an email at luis@onmywaytowealth.com. The information provided here is for information and education purposes only. The opinions expressed herein are solely those of myself, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by my firm or myself about other parties' information or accuracy or completeness. All information or ideas provided should be discussed in detail with a financial advisor, accountant, or legal counsel prior to implementation. Thank you.